Hello, everybody, and welcome to another episode of Fresh Perspective Planning. My name is Michael Mezheritskiy. I'm the president of Milestone Asset Management Group, a fee-only registered investment advisory firm with a couple of offices in Avon, Milford, and in New York. We oversee a little bit over $220 million under management. And joining me is Rich LoPresti, who runs our Milford office. Hey, Rich, how are you?
I'm doing great, Michael. How are you?
I'm good as well. We are trying something new today. We're going not just audio, we're also recording the video. So you guys actually get to see our faces. I got a fresh haircut and everything. So we're ready to roll.
We're trying to scare people away, I think. I don't know.
I know. We might have to turn it off eventually. But we're excited to be back and record another episode in 2025. I think one of the topics that Rich and I were kind of bouncing around some ideas on some of the things that we might want to cover today. And obviously, as we all know, as we're recording this episode in March of 2025, I would say there's quite a bit of volatility in the market, Rich. Wouldn't you agree?
Volatility, uncertainty, from day to day, it's another adventure out there.
A lot of stuff happening, and we are not a political channel, but we are going to get in and talk a little bit about volatility. How does it pertain to somebody who's about to retire? How does it pertain to somebody who has retired? What are some of the things that you should consider, in our opinion, and implement? Because when you do retire, guess what? That paycheck goes away. You go from accumulation part of your life where every 2 weeks you get paid, the money comes in, you can just count on it and go spend it to, well, kind of got what I got, and now I need to be able to support my lifestyle with the savings that I have accumulated. And I certainly don't want to necessarily be as volatile. So people get scared when there's a lot of volatility. And I don't know about you, Rich, but I don't think the media is really helping people kind of stay calm and rational, let's put it this way, during these times.
Yeah, I don't think so. I think they like to sensationalize a lot of stuff that's happening, and they think all that stuff is happening everywhere, but it's only in certain places and spaces. So yeah, everything is elevated. People are elevated right now with their emotions, and that can be dangerous for investing. Very dangerous.
Amen.
The last time I think it was this volatile that I remember was 2008, I would say. COVID too, a little bit, but that rebounded pretty quickly. But 2008 was definitely a very, very volatile, and it was a down year. This year hasn't been as down, obviously, but it kind of feels that way.
Yeah, I feel like it feels more volatile than it really has been so far. But at the same time, I think the uncertainty about political movement, tariffs, what is that going to do to the economy, how things are going to play out. I think there's just a lot of anxiety. And I think if anything you learn from this episode would be to turn the media off and go for a walk. I think if those guys on TV knew what they were doing or what's going to happen, they'd be doing it rather than telling you to do it. Right?
Yeah. Spring has sprung. Get outside. It's definitely healthy for you.
Amen. But listen, as a retiree, you definitely have to be prepared for this type of volatility. We teach a retirement class once a month. We actually just had one yesterday. And one of the things that Rich and I talk about during those classes is what we call a sequence of returns. And many times this is the topic that a lot of retirees and people just are unfamiliar with. Now, Rich, you want to tell us a little bit about what sequence of return is, and then we can talk about how that's applicable in retirement and potentially maybe some of the things that you could consider doing to try to alleviate that.
Yeah. Well, the sequence of returns is exactly what the name says. It is the sequence of the returns of your portfolio in the subsequent years from when you retire. So if I retire this year, the market's down 10%. Well, the market was down. That was the first return in the sequence. And then the second would be next year, and the third. So that's kind of how the returns in your overall portfolio kind of evolve and develop over time. So you can have an average of a 10% portfolio, but you could have a 20% down year, a 30% down year, and a 40% down year. And not to steal Michael's thunder, but if you're down 30, 40% and you don't have cash or a safety net or a bucket strategy, you're going to have to take your weekly, monthly paycheck that you're creating in retirement from that said portfolio that is now decreased substantially. And then there's a snowball effect, as opposed to if the market's up 30% when you retire the first year and up 20% the second, you're smooth sailing. You have no cares in the world. So
Ain't that the truth? I think so. The example that we use of that during our class, just to put it in layman's terms, is we have two couples. Obviously, they're both made up. Each couple has about $500,000, and they, at the age of 65, their average rate of return over time is 6%. So the amount of money they start off with is the same. The rate of return is the same. They each need $25,000 per year, adjusted for inflation. And then Tom and Sally, let's call it the first couple, get unlucky. So they retire and they get bad years first, right? So they walk into a volatility right at the beginning of their retirement. That's kind of like what we're experiencing right now. Imagine retiring in January of this year. And now you're walking into this huge uncertainty, and market is up and down, up 600 points, down 700 points. It's fluctuating all over the place. You bet it gives you anxiety as somebody who said, gee, should I have worked a little bit longer? Do I have a plan? Is my plan accounting for that? So just to go back to the example, because they had bad years first, Tom and Sally are out of money by the time they are late 70s, 78, 79 years of age, where Bill and Angie on the other side get lucky, right? They get good years first, and then they get bad years at the tail end of their retirement. They die with about $1 million in the bank. So sequence of returns is a really, really big issue. And we've kind of been reminiscent of that because we've had good market overall, right? I mean, we had a few years that there was a little volatile here and there, but overall it's been pretty positive. So you kind of forget the volatility that can come along with it, right? You just kind of remember
exactly.
short-term memory, right, Rich?
Yep, it's a flip of a coin. It's a binary outcome. And you can't eliminate market risk unless you're not in the market, right? But we have found and kind of discovered ways and utilized different strategies to help minimize that risk and mitigate that risk as well, which is great for our clients.
Yeah, you have to have a plan. And one of the topics that we're going to discuss on today is, okay, so the market is volatile. It's got to move around, whether you like it or not. Believe it or not, there's nothing you can do about it. It's either going to go up or it's going to go down, and you are part of it. So we're going to talk a little bit about some of the things that you can take, some of the steps that you can take as somebody who is retired or getting close to retirement to protect yourself. We call it planning. You must have a plan that accounts for it. So one of the things that we are a big fans of are bucket strategies, right? We talked about this in our prior episode, and Richard mentioned it earlier today. That bucket strategies is a really good way to alleviate some of your anxiety. Rich, you want to go over a little bit about sort of why the bucket strategy is so important, why all of our clients have it, and why we don't get any panic phone calls when the market is volatile, because we get ahead of it with the use of a bucket strategy.
Yeah, well, I take a step back. It's based on what your asset allocation is. And when I teach the class as well, I ask clients if they know their asset allocation, and some of them do, some of them don't. They get into sub allocation and kind of they don't know why they have the allocation they do. And asset allocation, the way I'm looking at it, is just simply the mixture that you have stocks and bonds and cash, or just stocks and safe assets is what I'm alluding to. But with the said bucket strategy, you can actually back into your asset allocation. You can actually have a reason why you have an asset allocation. So we allow our clients to have a safety bucket of either 5 to 7 years, which we're going to have cash, money market, paying 4% plus a bond ladder with 6 month, 18 month, 2 year, 3 year kind of bonds, and bonds kind of coming due for that safe bucket. But if you're kind of just want to kind of be safe, and say you need $100,000 to live off of, and you have $1 million portfolio, and maybe you have $30,000 coming in for Social Security, well, you're just going to need $70,000 per year to live off of. from your portfolio, roughly, without taxes and et cetera, because you have the other 30 coming in. So that's 100,000 per year. So we're just going to take that 70 and we're going to times that by 5. And now we have $350,000 of your portfolio is going to be in that cash, that safe bucket, where the other 700 or 650 is going to be in the equity or the more aggressive part of your overall portfolio. And when the market is down or doing poorly or performing less than what the risk-free rate is, which is the treasury, which is say 4%, well, we're going to take our income stream, which could be bi-monthly, monthly, quarterly, semi-annually, annually out of the portfolio from the safe bucket. And when the market is doing well, like it did the prior 2 years, which we've had record returns, 2
True.
years of plus 25% or so, if you're kind of fully invested in the S&P, which is pretty good. We're taking those gains and we're kind of paying our bills from that, and then maybe replenishing the safety bucket. If you want to be even more conservative, we'll do 7 years of that.
Yeah.
So that will roughly make you a 50-50 portfolio, because you'll roughly have about 500,000 in your safe assets and 500 in your equity or your aggressive portion. And by doing this small little change and tweak with your distribution strategy using the bucket strategy, it helps mitigate and offset a lot of this devastating return, because you don't just sell proportionally from a portfolio. So what I found out is that a lot of people are utilizing asset allocation portfolios with ETFs. They're cheap, they're efficient, they're easy to rebalance. But when they call their broker to say, hey, let me take money out of the portfolio, they just take it proportionally from both the aggressive
Yeah.
part and the safe part, while rebalancing the portfolio, which is typically a good thing to do, but not the best thing to do in a volatile market, especially one that is going down. So there you go.
Yeah, no, listen, this is exactly it. I mean, I think what you're describing, and it's interesting because I asked yesterday in a class that we were teaching, I said, listen, raise your hand if you've done that. In my opinion, silly questionnaire of, here's 10 questions that you can answer, circle the best answer. Now we're going to computate your asset allocation based on how you feel. You know, if the market drops by 30%, how would you feel? A, great. B, not so. They make no sense to us. And you know what?
No.
They also don't make any sense to the clients. It covers, you know, firm, the advisor. I get it. There's a big part of that. But it doesn't get to the bottom of, okay, well, why are you invested at 60-40, 70-30? What you're describing using the bucket strategy, the clients then determine, okay, well, how much of my income do I want to have on the shelf, meaning that not in equities? And that's the mathematical way that we get to it. And yeah, guess what? They understand, right? They know, okay, well, I have 8 years of income stashed away, that if the market is going to go down and I have a couple of bad years, I don't care. I can still continue to do what I need to do because I'm protected.
Right.
Oh, that means I'll
100%.
be 50-50? Okay, great. I'm okay with it because I understand the outcomes and why I'm doing it. It's just so much more logical.
People panic out of the market as well too, and so you need to really have an asset allocation. That's like the foundation. You have to know why you have it. And you have to stick to the allocation and be comfortable with it. And you don't even have to worry about what's going on in the market, because you know exactly why your portfolio is set up the way it is, and it's going to do what it's supposed to do for you, so to give you peace of mind.
Exactly,
In
which
the
is
longer term.
exactly what it's all about, is having a peace of mind. So let's say, so now that we have figured out our asset allocation, we have the bucket strategy, right? The things are implemented. The market is volatile, you know, so you have this whole section of your portfolio, of your nest egg, that's fluctuating, right?
Yeah.
So most of the time, people that I come across, they just say, we just sit tight, which is partially correct. You never want to go and start selling things off or listen to the TV and the guy is telling you that the market is going to go to hell in a handbasket and you come out. That's the worst thing you can do, because you will never get back in time. And what you're doing is you're realizing the loss. Paper loss, real loss, two different things. However, sitting on your hands and not doing anything is also not necessarily the best way to approach this. You know, typically, from what we've seen, a lot of our clients, they have a multitude of account types, right? They have brokerage account, non-retirement monies. They have traditional or 401k, pre-tax accounts, and then some of them have Roth accounts, or if they don't, we typically set one up for them. So there are some steps that you can take because there are always, in my opinion, and correct me if I'm wrong, Rich, but there's always opportunities, even in a bad market, to go in and take advantage of certain things. One of them, let's kick it off with tax loss harvesting. Maybe you can kind of educate us a little bit, Richard, sort of what that is, why it's important, and high level, how do you use it? What is that big shiny thing is?
Yeah, well, I mean, tax loss harvesting is when you have an investment and you have a loss in it, you can take it and realize it simultaneously by buying a like security, something similar to it, right? So you have an S&P 500, you have the SPY, and you're down 10% in that. So just say you have, $100,000.
Yep.
You're down 10%, so that's $10,000 loss. At the same time, you could look at maybe into a growth fund or a growth ETF that has similar characteristics to the S&P 500, and you basically sell the SPY. You realize a $10,000 loss that could offset future gains that you have within a portfolio, any interest, or different types of gains you have from a taxable account, and then you buy that said growth fund. I'm say SPY, and now I'm buying DGRO, which is the dividend growth fund. So there are two different types of funds, and that qualifies. It would not be a wash sale, and I'd have that loss. So it's better than not having a loss, and I'm not losing that exposure, and it's going to be pretty similar because it's going to track pretty similarly as well. So that's a benefit because taxes are expensive.
Taxes are expensive. So what Rich is referring to is basically when the market is down, the market is not going to be down forever. Eventually, it's going to go back up. I mean, think back to 2022. So in 2022, when we had a negative year, market was down 22, 23%, something like that on the S&P side of it. Through the year, so let's just use your example, SPY, right? S&P 500 ETF. It's down 100 grand. It's down to, 80 because it's down 20%. So when you go in and you sell, so that happens instantaneously. You sell the S&P 500, you now have a credit of $20,000. You lost $20,000 off of your investment. Now you immediately turn around and take that 80,000 and you put it into a different growth fund, not S&P, but something fairly similar to it. So you're back in the market. So when the market goes back up, you're still in it, but on paper you have a loss. You have $20,000 worth of losses. Fast forward to 2024. You decide to go on that vacation, right? I want to go on vacation. I need to sell some assets to generate it. Well, the market is up. You don't have any losses in your portfolio. Your positions have recovered since they dropped in 2022. So now you go in and you sell something and you have a long-term capital gain of, let's say, $20,000. Well, because you have a loss that we're carrying from 2022, you can use that to offset your gain. So instead of having a $20,000 long-term capital gain bill going on your tax returns, the tax liability reaches what?
Zero.
Zippo.
Yep.
Zero. And guess what? When do the long-term, when do capital losses expire? The losses we realized in 2022. How long can we carry it on the books for?
Just keep carrying it.
Forever.
Yep.
Forever and ever. And if you don't use the loss, you could take $3,000 every year and write off of your income tax if you choose to. But it's a very powerful tool that a lot of people miss out on because they just don't know that they can do that. And you're really not out of the market. The key is to sell and then buy something similar. So this way you're not selling and going in cash for 30 days and waiting to go back to the same position you sold. You're instantaneously selling and buying something else.
Yeah, you're not trying to time the market. You're just trying to keep your same allocation.
Exactly. We're long-term investors.
Yep.
100%. But having that loss is so important because eventually you're gonna have to sell something at a gain, right? I mean, that's market will go up eventually. Things don't go down forever.
Right.
So that's a very interesting strategy. The other one that we are very, very big fan of, and if you go back and you listen to our first season, you'll hear a lot about Roth conversions. Now, a legal disclaimer: in order for you to do conversions, you need to have a plan. This podcast is for educational purposes only. You got to go talk to somebody who understands this, your accountant, your advisor, before you run out and start doing conversions just because you heard somebody talk about it on the podcast. But we are experts with it. We do a lot of Roth conversions. This is our unique value proposition, is tax planning, because you know what really is interesting to me? Many advisors do not provide advice on taxes. Did you know they'll send you to an accountant, right?
True.
What's the number one expense? Like, what's the largest expense that somebody faces in retirement?
Taxes.
How do you not
Especially if
advise
they
them?
don't have any kids. If they don't have any kids,
Yeah.
it's definitely taxes.
Kids are always an expense. I got 4 of
Or
them,
great
so
kids.
yeah.
Yeah.
But the point of the matter is that when you retire, taxes is going to be your largest liability. So, and Roth conversions could be a nice way to manage it. You have to have a plan. You have to have a reason for doing conversions. You have to have an accountant to be able to go through and double check and verify. We have one on staff, so we can definitely talk from experience. But Rich, just for our listeners, maybe you can educate us a little bit on what exactly is a Roth conversion? What is this big fancy phrase? What are we doing here?
Yeah, well, a Roth conversion. What's a Roth, right? William Roth actually created the Roth.
There you go.
I love him. He's the best. He created this tax-free account. But most people have tax-deferred accounts. So they've been told since the late 70s to invest tax-deferred in traditional 401ks, where you take your money, just say I'm putting $10,000 in this year for simple terms. I will able to lower my income by $10,000 investing in this tax deferred account. So I'm going to save a little bit in taxes that year, depending upon what bracket I'm in. It might be like $200 or something,
Yeah.
or what, $2,000. It's very, very minimal savings if you fast forward 10, 20, 30 years to when you actually retire. Now, the Roth is the opposite. The Roth, there is no tax deduction, but it is not tax deferred. It is what they call tax free. So anything you put in the traditional, again, if that 10,000 grows to $1 million, well, you owe $1 million in taxes. So many people don't realize they're partnering with the IRS.
Yeah.
And we want you to do really, really well. And that's another reason why the market continues to go up.
When you win, they win.
Because that account will be taxed. If you're at a 20% tax bracket, that's 200 grand just for federal. So that $1 million is really only 800,000. Whereas you put 10,000 into a Roth, you don't get that deduction straight away, but that 10,000 could grow to $1 million, and that whole $1 million is yours. So the Roth is a tax-free account. So what Michael is alluding to is a Roth conversion, where you take some of the money from that tax-deferred account and you move it to the tax-free account. And it's sort of like an art and a science. Again, figuring out a plan, how much you should do. We analyze tax returns and such. But if you let me continue, Mike, I can give you a pretty interesting example right now of why it could possibly make sense to do a Roth conversion with a lot of this volatility.
Yeah, let's just pause for just 1 second. I just want to kind of add a little bit to what Rich was saying. So the reason is why? Why do we do Roth conversions? Like, okay, so we're putting money aside, we're deferring it, we're putting it into a 401k plan, we're getting a deduction on our income taxes today. And when I retire, I'm going to be at the lower tax bracket. I heard it so many times, and we are here to tell you that that is a myth. It doesn't happen most of the time, right? When you retire, you might have a small window from your retirement date until you have what's called the required minimum distribution. It's my favorite phrase, RMD, because guess what happens? At the age of 73 or 75, depending on your birth date, you can no longer continue to defer, right? You have to start taking distributions out. So what happens then is that you're floating, right? 10%, 12%. You're a happy camper. You're not making any money. You're not paying much in taxes. Your Social Security is practically tax-free. And then if you've done a really good job of saving, which a lot of our clients, actually all of our clients have, you get a really big paycheck that now you have to start take out. And that paycheck puts you into many times back to the exact same bracket you retired from, and then some. And that required distribution never goes down. And then all of a sudden, you're paying taxes on Social Security. Your income is right back up. You're back to IRMA. I had a long conversation this morning with somebody about IRMA and sort of how that operates, because Medicare premiums are based on the amount of money that you're making. So everything is tied in to your income. I met somebody yesterday at the class who is 75, and she came up to me afterwards and she said, Mike, everything you're saying about RMDs and how much of a pain in the neck they are and how much I'm paying in taxes is crazy. I wish I met you 10 years ago when I had the opportunity to do something about it. And to do something about it is the process potentially of doing Roth conversions. The thinking behind it is that you should be able to look down, and we have tools that help us do that. See down the road, what is going to be roughly in my bracket when I do hit that required distribution? And say it's 25% or 28%. Okay, well, I know that I'm going to be paying taxes. We can see that. Question then becomes, does it make sense for me to do conversions now and pay a lower, potentially lower tax bracket today so that I never have to pay taxes on that again? And then at the same time, the more you wait, we just talked about this, the more your tax deferred accounts are growing, the more IRS is happy for you, because that means your distributions are going to be larger. And when your distributions are larger, guess what else is large? Your tax bill. So I just kind of wanted to preface that a little bit before you go into your example. So go ahead, Atish, take us through an example you got going on today.
Well, I just think, example aside, if you're 60 years old and you're going to retire, as a planner, we plan out to the 90s for married couples.
Right.
So that's a 30-year period, in our estimation, right? Pretty simple, straightforward. And then there's an additional 10 years if you care about your child and the government not being your biggest beneficiary. So you technically have about 40 years for this conversion that you do, say, today, to grow enough to offset the taxes that you pay today. And by the way, you're going to have to pay the taxes anyway down the road at 73 or 75. And then your kids are going to have to pay the taxes when you pass. And if you're married, your spouse passes as well, because non-spousal beneficiaries, Michael, have to take out all of their money from IRAs and Roth IRAs within a 10-year period. There's no more stretch IRAs.
Right.
So mathematically, if you have $1 million and you have a 40-year period, you're going to have about four doubles of that said million if you have some other cash and other assets to take out. You're never going to touch these dollars.
Right.
Even if you touch a little of them, it's still going to grow. So you have $1 million in a 10-year period. If you have a 7% return, now keep in mind the risk-free rate with the treasuries right now is 4.3, 4.5 for a 10-year treasury. So you're kind of right there. 7% return is not a big stretch, especially since the S&P has averaged a 10% return for almost 100 years. So that million in 10 years doubles to 2 million. The next doubles from 2 to 4. And the next doubles from 4 to 8. You pass, a traditional IRA goes to the kids, and they'll have to take that out over a 10-year period and be in the highest tax bracket. So probably half of that 8 million is gone. So they're only inheriting 8, maybe inheriting 5 if they have some growth. Whereas that same 8, your kids can actually let stay in the market for another 10 years if they don't do it, because when you pass, they'll probably be in their prime earning years.
Yeah.
That 8 can grow to 16, and they can have 16 million for them and their grandkids, maybe your great grandkids, tax free. So that's huge. That's
beautiful
just
math.
Overall, just if we paddle in the right direction, but that's a little off, you're still going to be in an okay space. There's so many examples, but hindsight obviously is 2020, makes you brilliant, but there's always ups and downs in the market. So when doing a Roth conversion, we're looking at it for a longer period of time, is what I'll stress. So even if you do it today and the market drops another 10%, that's okay. 15%, it's okay because we're looking at it longer term and we're going to continue to do conversions at lower and lower rates. We're not going to be able to predict the market.
Yeah, I mean, listen, nobody is. And if you on this podcast and you think you can predict the market, call me because I will
Yes.
hire you on the spot.
Yes.
But you're right. Using Roth conversion, just to kind of go back to sort of the topic of this podcast, is like, okay, what can you do during volatile times? One of the things that you can really well implement during volatility and use it to your advantage is conversions. We do conversions throughout the year because typically market moves around in different directions throughout the year. We've had a really big bunch of volatility here earlier in the year. But the idea is when the market drops, you convert. And when you convert, you move money from tax deferred to tax free account. So now when the market recovers, that recovery is happening at a tax free format rather than tax deferred. And then we've had a lot of volatility this year from I think one day market dropped 1,300 points, then another day market dropped another 1,100 points. We weren't just sitting there watching it. We were doing conversions for our clients that have already completed their tax returns, and we ran the numbers and we kind of know what the income predictions look like. So there's just a lot of steps they go into. We don't just start converting like crazy. But if conversions work for you and you have a plan and you kind of have a team that helps you sort of navigate that, that could be a very impactful tool. 5 years from now, you look back at it and you look at us and say, those guys were geniuses because they've converted and they bought all those things for me down when the market was super volatile. And now 5 years later, it doubled. And it doubled what? Tax free. I don't have to pay a penny on this particular gain. Isn't that a beautiful thing?
It is amazing. So I mean, it's also like I'm saying, it's also not apples to apples because you're looking at your asset allocation, but the asset location is just as or more important. But just say you have a 50-50 asset allocation. When we first start to make those conversions, we're going to start converting your equity portion, your equity piece. Right. And you're actually going to do better than the 7% that I said. I mean, there's no guarantees in this industry, but I figure if everything goes the other way, we're not going to have to worry about any of this anyway, because your money's going to be worthless.
True.
But that's not going to happen. But just think if you have a portfolio built on index funds and maybe you have a little bit of a concentration in, say, like the Max 7 stocks, for instance, and just over the past few weeks, they lost 10, 15, 20%.
Yeah.
And you move those into your Roth and now they're back up 5, 6, 7%. You'd be in a pretty good spot. What if you own some of those companies outright, right? Like a Tesla, which could be a little controversial right now, but a lot of stuff is happening to bring that stock down. It was almost at $500 about, I don't know, a month ago.
Yeah.
And it hit a low of 225 when Tim Waltz said that he'd like to see it go down. And now I think somewhere around today, it's almost back up to 300. Not to say you're going to time that. And again, hindsight's 2020 to make you a genius. But if you're going to hold those positions for a long time, well, it's a lot cheaper than it was a month ago. And if you made that move, over the longer term, you'll be happy. It's not going to always work that great, if you made that, because there's some people out there that did do that, I'm sure. I know firsthand, but anyway, it's very, very powerful.
It's some of the things that you can do when the market is volatile. And I know that we're covering this at a very high level. The idea here is to just give you some education so you guys are aware of the options. Now, we are the experts in it. We do this all the time. So if you're listening to this podcast and you say, gee, what Mike and Rich are saying kind of resonates with me, but I have more questions. Well, in our show notes, we're going to have our email address, our website, our phone number. Please feel free to reach out. We provide complimentary conversations with people. We are fee-only fiduciaries, so we don't have any products to sell. There's no commissions. We're more than happy to speak with you if you feel the Roth conversions might be something that you should consider, but you're not sure where to start and how to do it. By all means, please feel free to reach out, and we'll be able to either help you or maybe point you in the right direction. Either way, you'll walk away knowing a lot more after the conversation with us than you did before. Fingers crossed, hopefully.
Yes.
So as we're coming to the end of this episode, we try to keep our episodes around 30, 35 minutes or so. I feel that we've covered quite a few things today from volatility perspective, some of the things that you could do. But the more important part is don't panic. If you have a plan and you understand your plan and you believe in your plan, you should be just fine and you should be able to weather all the storms as far as we are concerned. History tells us that, right? We've been through a lot of stuff before and the market has been very, very resilient over time. The key is to have a strategy, to have a plan. When you have a plan, you can sleep at night. So anything else you want to add to this, Rich, before we kind of wrap another great episode up here?
Yeah, the only other thing I was thinking of is it's taking us back to the sequence of returns and just withdrawals. And I'll try to be really, really quick because you have a certain lifestyle when you retire and you want to live that lifestyle. But if you have, $1 million portfolio and you're taking out 5% from that said portfolio, that's $50,000 per year. But if you have a down 20% year in your portfolio, you only have $80,000.
True.
$800,000.
Right.
So your 5% of that is only 35,000. So you really need to make an income adjustment there and not continue to take the 50 out, because if you have another down year, you're going to take out too much money too quickly, too soon. So instead of going on big vacations that year, maybe you do some staycations. Instead of going out a lot, you have some big barbecues at home and invite people over, and you don't really miss a beat. And then the market recovers and you give yourself a raise the next year. And this is something that we help people with, make these adjustments, not very often because they're set up pretty nicely by not just only us, but them working so hard and doing the right things for all of the years. We're just making some slight tweaks and changes to their portfolio and helping them organize it holistically. And, it's just having a plan. What if crap hits the fan? What do I do? Do I panic? No. So.
Yeah, you're absolutely right. We call it guardrails here internally at Milestone. We call it guardrails because you're 100% right. If the market is down, there might be a point at which the decline will cause you to spend less. The best part about sort of what we do for our clients, I think, is that we tell them in advance what those guardrails are. So our clients know what their portfolio needs to decline by in order for them to go in and spend less on a monthly basis. So not only do they have a bucket strategy set up, they have X amount of years in investments that are not going to go down because of market volatility, but they also know what their equities need to go down by before they need to make an adjustment to what they're spending. And guess what? We run those plans automatically for them every month. Whether they come in, whether they call us, whether they email us, it doesn't matter. We run them. And if there is a call for an adjustment, they'll hear from us, right? Myself, Rich, Danielle, Adam, anybody on the team here at Milestone will reach out and say, hey, here's what's going on with your plan. Your guardrails has been triggered. We've never had to make that call because a lot of our clients, actually most of our clients, don't spend as much as they could be spending. So they have quite a bit of wiggle room in how much they have to lose before the guardrails are triggered. But every one of them knows what that percentage is. So they go online, they look at their accounts. Oh yeah, the market is down. Am I down 30%? No. Okay, I'm going to move on because I don't need to make any adjustment. I carry on. That's a very powerful feeling in retirement, wouldn't you say?
I concur. I agree. And they're going to pay less taxes, so they will have more money to spend as well. So, the bottom line is we try to do the things that we can actually control. We know we can't control the market, but we know we can control how and when we pay our taxes. We know how we can control where the money is coming from for the withdrawal strategy. Is it a taxable account, tax deferred, tax free? I know we're trying to wrap up, but there's so much in there.
I can talk about it all day long. We absolutely good. Hopefully you guys can see we're very passionate about what we do. We love what we do. We don't do it for the money. We feel that good financial planning is very important in retirement. And hopefully you found this episode to be helpful. But like I said, if you have any questions, if you feel like you want to clarify something with us, in the show notes we'll include our contact information. So please feel free to reach out. And we will be back with another episode in a couple of weeks, and we're going to continue to put out this content, and hopefully you guys don't mind the cameras on.
All right. Sounds good.
Well, very good. Well, thank you everybody for tuning in. Thank you for listening. Another episode is out for Fresh Perspective podcast, and we will talk to you guys soon.